Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Joe O'Malley with the ETF and Index Strategy team at Invesco. Joe, it's great to have you with us. Welcome to Trade Talks.
Thanks, Jill. Great to be here.
All right, let's talk about momentum strategies. What are some of the benefits of using a momentum-based investing strategy?
So there's a number of benefits to utilizing a momentum-based investment strategy. First off, momentum is a highly rewarded factor. It's been shown to be one of the strongest generators of excess return. And really the basic idea is that a persistence effect exists, which is the idea that the winning stocks will continue to do well. So when we look at momentum, there's really two major types of momentum. The first is going to be time following, which is largely present from an academic approach. So kind of the idea that over a given time period, say the trailing 6 or 12-month period, those stocks that have done well over that time period will continue to do well. The other type is peer focused or relative strength, which we utilize in our suite of ETFs. Now, in contrast to fundamental analysis, which typically seeks to identify what to buy, relative strength seeks to identify when to buy or sell a particular stock. So the idea of buying based on strength and selling as that momentum dissipates or that momentum shifts. So from an investor behavior standpoint, we find this to be a very helpful thing because it helps to eliminate some of that disposition effect that you'll see. So investors tend to sell winning investments too soon in order to capture those gains. And then on the flip side, investors tend to hold losing investments too long just in hopes of a comeback.
Invesco offers 13 distinct strategies that leverage Nasdaq Dorsey Wright relative strength methods. Give us an overview of that.
Yeah, as you mentioned, we offer 13 distinct ETF strategies in the momentum space. 9 of those are going to be sector-based portfolios. So for those that are looking to emphasize a certain sector or play a certain sector, these can fit in quite well for that. We offer 9 of those strategies, so 9 of the 11 GIC sectors. The only 2 that we do not have offerings in are communication services and in real estate. We also offer 4 broad-based portfolios, 2 of which are international, so 1 developed markets and 1 emerging markets, and then 2 broad-based domestic options. So from a large cap perspective, we offer PDP is the ticker symbol, and then small cap DWAS. And these are our 2 most popular. They have the 2 largest, they're the 2 largest in terms of AUM as well. So each of these 13 ETFs is going to be based on Dorsey Wright's relative strength scoring methodology. They're strategies that are rebalanced, reconstituted on a quarterly basis. And what you'll typically see with these strategies is a high level of turnover. So, this is helpful from an investment perspective to keep up with, where the most strength is or the highest momentum is in the marketplace today. But it also fits very well into the ETF wrapper due to its tax efficiency, the idea that of in-kind creation redemption process. Even though it's a high turnover strategy, that process can help to reduce or what we've seen for the most part, eliminate the potential for capital gains.
Let's go back to the 2 domestic strategies that you had mentioned before, PDP, the large cap, and then DWAS, the small cap. Are there any limitations on sector exposures, and how have these sector allocations changed over time?
Yeah, that's a great question. So there are no limitations in terms of sector. This is purely a momentum-focused strategy. So it will be, in terms of PDP, the 100 highest scoring relative strength companies. In DWAS, that number's 200, and again, there's no sector limitations with those. What you do tend to see over time is you do tend to see an overweighting or an underweighting of certain sectors based on this strength or lack of strength in the underweighting. It's something that you've seen from an overweighting perspective in the mid 2010s with healthcare. That was followed by a period of overweighting within information technology from the late 2010s to the early 2020s. And what we see today is pretty interesting. 2 years ago, we had almost no exposure to energy in these portfolios. About a year ago, we really started to see energy being incorporated into these portfolios. And now we're at significant overweights in energy in both of these portfolios. And energy has been really the lone bright spot over the last year. So something we're optimistic about and something that we like with these portfolios.
All right, Joe, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.